Hey YouTube, Jason here with Day Trading Fearless. Welcome back to my channel. If you're new, welcome. Make sure you guys hit the like button and also subscribe. And all these option videos are sponsored by myself. So these are the weekly trade zones for the S&P Emini futures. $50 one-time payment for a lifetime subscription. I've been doing these for about 7 or 8 years now. And every weekend I send you all these trade levels. Again, $50 only. Go to daytradingfearless.com or click the link down below in the description. And also make sure you check out my Patreon page at patreon.com/daytradingfearless to follow along with my trading portfolio. So, with that being said, let's jump into the option video course, and I hope you guys enjoy it. And thank you for watching. In today's video, we're going to talk about a bull call spread, or they're also called vertical call spreads. Whenever you hear vertical call spreads, it could be bull call spread, bear call spread, bull put spread, bear put spread. But a vertical call is also known as a bull call spread. So, market opinion. Moderately bullish to bullish, so somewhat bullish to bullish. You will always pay a debit for this. A bull call spread is also called a vertical spread. It contains two calls with the same expiration but different strikes. The strike price of the short call is higher than the strike price of the long call. This is a bullish spread where you are long a lower call and you sell a higher call at the same time, which will limit your upside profits, but also limit your downside losses. You will pay a debit for this trade and want the stock price to go above the call that you sell by expiration. So this is what it would look like. Current stock price is at $20. You would buy one XYZ October 20 call. You would sell one XYZ October 25 call. Your total cost would be $2 on the trade. Your max loss is the $2 debit you pay. Your max profit would be the $3 that you pay. And your break even is if the stock closes at $22. So here's an example. You will buy one XYZ stock one XYZ option October 20 call, and you will sell one XYZ October 25 call, which is a 5-point spread, and the spread will cost you $2 with a $3 profit potential. The difference of the two strikes. So if it's a 5-point wide spread and you're paying $2, well, you can make 3. Vice versa. If you paid 3, you can only make 2, right? The current stock price is at $20 and you will need the stock to trade at $22 on options expiration for this trade to break even because of the $2 that you paid for the spread. Your max profit of $3 would be if the stock closes above $25 at option October expiration, and your max loss of $2 will be if the stock closes below $20 at expiration. This is a bullish spread where you want the stock to move higher and trade above $25 and realize the entire max profit. So let's look over here. We'll go back to Viacom. Okay, let's look at the vertical. And let's actually go out to June. Okay, and let's look at the 41-42 call spread. Okay, with the 41-42 call spread, we are going to pay 43 cents for it. Okay, and what we're doing is we're buying the 41 and we're selling the 42. So if we come over here, okay, we're buying one. Our break even is the 41 plus the 43 cents that we're paying, right? So the 41 strike plus the 43 cents is our break even. Our max profit's 57 cents or $57 because from 43 all the way to $42, the 42 strike is 57 cents. Our max loss is what we pay for this spread, okay? And our buying power is only $43, the most we could lose for this trade. So going back to this, as long as if we close like above $25, we will keep the full $3. Now, if we close at $23, going back to this, we paid $2, but we're at 23, our break even's 22 plus $1 extra, we will make $100 on that trade. So that is what a bull call / vertical call spread is.